Hey guys, Whitney here. I am joined today with Taylor Koo, one of our investor relations associates, and we are so excited to be together today to talk about the 4 different ways that investors actually maintain control in a passive investment. But I know you guys are still filing in the room, so we're going to give you guys just a moment. But I'm going to go ahead and kick us off while you guys are getting oriented. And for those of you, if this is your first time joining live, this is the Passive Investing Made Simple show. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. I'm joined today with Taylor. Yay, I'm so excited. But this is a weekly live show where we take a deep dive into the various topics related to passive investing, passive real estate. That way, not only can you absorb all this knowledge and learn, but actually put it into action. All right, so you can confidently go into your first or next investment with us here at PassiveInvesting.com. So be sure to go to PassiveInvestingWithWhitney.com. Register for future masterclasses. You'll also have access to be able to get on my schedule, ask any questions that you have about real estate, and also see our deals. I see that there's a few hands raised already. Yay, high five. If you have a question, open up your Q&A box and drop your question in there. Where it makes sense, we will answer those questions live during the show. Otherwise, we will host our after party session, rewarding you guys here that are live, and do a little bit kind of an Ask Me Anything session. All right, so I am joined today with Taylor Koo, who is a member of our investor relations team with PassiveInvesting.com, and he is going to help me break down today's topic, which are the 4 different ways investors may maintain control when they invest passively. Taylor, awesome. Thank you so much for joining me. It's hard enough to talk about it on our own, but we have got some great dialogue planned out for everybody today.
Yeah, I'm really excited to hop on. And can I just say, it is an honor to be able to hop on with the Whitney Elkins-Hutten. I've been following the content, and I've been trying to model my podcasting after you. And so just to be able to share this webinar with you, it's quite an honor. So I'm very excited to be here and talk about this, just because there is just that common misconception that passive investors don't have control, and that just isn't true. And I think what investors mistake with control is what it actually is. And so when we talk about control, we're talking about determining the behavior of supervising the running of. It doesn't necessarily mean the elimination of all risk, or rather the mitigation of risk. And so, if we're going to be comparing the stock market, for example, sometimes that feels like we have control because we have the ability to liquidate in case anything goes wrong. But at the end of the day, we also have no control over what that actual company is doing. For example, Tesla. We don't have any control with if Elon is going to tweet about Shiba or Dogecoin and really run up the Tesla market, or even Dogecoin, for example.
I know. Well, sorry. Elon's kind of made himself an easy target here.
He's great.
For those of you who are Tesla fans, I like Tesla too. The Tesla plant is right down the street. but no, I think you're right. So I think, that common misconception, just to sound it back, is people think control means you actually can impact every single point of that process, and you can't. You can influence, right? There are certain questions we can ask ourselves to make sure that we're kind of understanding what we're getting into, mitigating risk as much as we possibly can, but there's no way to eliminate all risk. So let's dive in. Let's dive in with the first way that investors can actually start maintaining control of their assets. And these principles apply across the board: investing in real estate, investing in, an additional security. Well, that number one is understanding your investing goals, right? What is it that you need from your portfolio? Do you need cash flow? Do you need equity? Do you need diversification? Do you need tax benefits? What is your investing horizon? Is your goal to invest for the next 3 to 5 years? Or do you need assets that, are out to 5, 10, 15, 20 years, right? What is your horizon? That all falls into your goals. Taylor, like what else would you have to add there?
Yeah, well, I would just say when you are talking to another operator, if they don't ask what your goals are, I think that's definitely a red flag, because at least when I hop onto the call, I want to hear more about their situation. What and similar to what you were saying, their portfolio, and what are they really looking for? Are they looking for an asset that has more cash flow and that supplemental income that they can rely on each month? Or are they looking for more of that back end equity, just trying to get the highest ROI on their capital? Or maybe they want a blend of both. Maybe, I mean, I've talked to some people that are retired and don't necessarily care about the back end equity, and they just want to have that 6 to 9% cash flow and be in that preferred equity stage. Or maybe they're working up to retirement and they're trying to get a little bit of both to help pay off their bills, but then still grow their to still grow their wealth in their portfolio. So I mean, when it comes to control and invest in these investing goals that we have, really just taking a look and an assessment of just where we currently are at this time.
Yeah, no, it's so true, because I mean, I've talked with investors as well that didn't understand the goals, and then they got into an asset and they're like, whoa, I didn't know that that's how the asset was going to run. It just doesn't, I needed the cash flow now. It doesn't cash flow for like 2 or 3 years. That's a problem. So, really understanding your goals. In
Yeah.
tandem with that, I hate to move off this topic. You also have to understand, as part of your goals, what is your risk tolerance?
Mm.
We alluded to the, tangible aspects of your goals. We talked a little bit about the investing horizon, but also the risk tolerance. What are the different business plans that an asset can go through? We can have a core asset, a core plus asset, value add asset, a development asset. All those are going to have different return profiles and also different risks that come along with those profiles. So Taylor, like, how are you talking to investors about the different types of profiles and, kind of sussing out what their risk tolerance is?
Yeah. So first off, when I do talk with them, I get it sort of some insight on what they've currently invested in. And sometimes they're more into these higher risk assets, or maybe they're more on the conservative end. But then also, even with that cash flow and back end equity question, gives me a little bit more insight about what type of risk that they're willing to take. And so typically when it comes to these like development deals where they're not seeing any cash flow for the first, let's say, 2 years, or maybe not cash flow at all, because they're just looking to sell it off at the end, being able to know that, hey, you're not going to be able to see this, and you're going to have an immense amount of trust that the operator is going to be able to do what they're saying they're going to do. On the other hands, though, the ones that are looking for more of that cash flow and immediate income and just that quick turnaround for those monthly distributions, you can also, I guess, get a little bit of an idea whether they want to have that cash flow right away. So at least they know that it is cash flowing and they're getting some form of return, and that trust is still being built along the way.
Yeah, I think it's a great point. The money is being returned. You're de-risking your investment as quickly as possible because you're getting cash flow back.
Yeah.
Okay. All right. What's our second way that we investors can maintain control?
Yeah. So the second way is you get to decide who you want to invest in. Who is the actual operator that you're going to be investing in? And this is really going to also align with the goal aspect, because you get to see what the operators are specializing in. I mean, is the operator, and also what type of business plan that they're in as well. I mean, there's some operators that are strictly into development. There's also, like you said, there's operators that are strictly over into the traditional value add, maybe workforce housing, bringing a C class to a B class, or you can go to your core plus assets that are more conservative, and there's still some form of light value add or innovation plan, but to still boost the enforced appreciation, but it isn't as heavy of a value add as other operators. And so, I mean, just taking into account their business plan, how they're identifying the risks within their markets that they're selecting, and then also the market that the operators are in makes a huge point as well.
Yeah, but before we move on to that part,
yeah,
I want to throw some nuggets out of the crowd here. There are questions that people should be asking operators, like when you hop on the call. Do you like them? Do you know, like, and trust them? First of all, I know Dan Handford, are one of our founding members. Also, he heads up our investor relations team. He talks about this all the time when he helps train other operators, that are looking to get in, or mentor, other operators that are getting into the business. He talks about this know, like, and trust triangle. You can seem like a marketing angle, but at the same time, you need to know, you're handing over your hard-earned money. Like, do you know this person? Do you like them? And do you trust, kind of like what you've already said a few times here, Taylor, that they can actually execute on their business plan? Do they seem genuine, authentic, transparent? What is their background? Ask about their background. Like, what is their background in business? What is their background in real estate? Who on the team has the experience to be able to carry this business plan, or the combination of the experience together? How many syndications have they done? How many have they taken either to a refinance stage or a sales stage, cycled out of? What are the returns have been? How does that compare to the initial pro forma? And guys, if you are going, wow, he's going way too fast, you can either rewind or I have an ebook for you guys with all these questions lined out in there. You can go to passiveinvestingwithwhitney.com, download the ebook there. So I have this all outlined for you. You don't have to memorize it.
Yeah. Well, I do want to touch on that too. So there is that ebook, and then there's also another article online as well with the 7 red flags of when vetting vetting operators. And yes. So it's also Dan, he wrote his article on, and his experience and what he likes to look out for, and also what is a red flag for him when he is talking to other operators. And so one of the big things that I would say as well, to touch and add on to this, is making sure that the values are aligned and the goals are aligned, but then also, how are they communicating to you as the investor? I mean, we can talk about, there's going to be monthly reports and quarterly financials, but how accessible are they in between that? Are they pretty responsive? Or do you have to wait 2 days, 3 days in order to get a response? That was one of Dan's biggest gripes when he was investing with other operators, and especially if some of them were part-time, is that he couldn't get a hold of these operators. And so now he had no idea what was happening with his investment.
Mm-hmm. And are they happy to hear from you? That's for me. Like, if I have a question, you're just like, wow, this seems really like tedious to answer, but it's hugely valuable for me as an investor. Are they like responding like, great to hear from you, let me get you that answer? Or they're just like look on page 16 of the investment summary and here it is, right? So I think there's also, again, it goes back to that know, like, and trust. There's a question, Taylor, we've talked about it before, and that is, making sure to ask the operator, what are the major risks of their investment strategy, right? You talked about having that alignment, but we want, as investors, we want to make sure that we're getting, the understanding from the operator, what is the business risk, not just like the standard answer from the Securities and Exchange Commission that they make us disclose. Like, you could lose all your capital, the suspension and distribution, right?
All the scary terminology that comes within the PPM.
Yeah, the 25 pages that are about to scare the pants off of you. But really, like, do they tangibly understand their business plan, and the actual risk profile of it? Because multifamily, self-storage, hotels, as we know, all have, car washes all have a different risk profile associated with them that go beyond just those like standard 5 things that could happen with your investment.
Yeah. Where was the question with that one? It's because it sounds like you answered the question. I was like, yeah, you're definitely right. I mean, there is a different risk profile across all the different asset classes, and also it's a different business plan as well. So I mean, if you're taking a look at multifamily, you're only able to increase rents, let's say, after a year, but in self-storage, you're only able to increase rates after a month. With car washes, I mean, it's just a different model. With hotels, it's a different model. It's a daily rates. And so just kind of understand, how the business is interacting in the business plan with the financials and with the returns and with the financing. Of course, high level, you don't necessarily need to go deep into the details unless you'd really like, but seeing how it all comes together as a whole.
Yeah. So the question that we left the investors to ask is like, what are the investment risk associated with the strategy they're investing in? Now, Taylor, you alluded to this, it's the operator. And, I want to recognize one thing before we move on to our last two, because there's a huge responsibility here that the investor has, right? When in maintaining control, they actually are taking on ownership and accountability for their investment strategy, right? So this is very different than taking your money and handing it over to a fiduciary advisor and kind of hoping. I always say hope's not a strategy, but you yourself, you are like the captain of your own boat here. You're in charge of whether, at a high level, your strategy is successful or not by understanding your goals and who you invest with. So those are the two biggest ones for me that I really love helping investors understand. But now we're starting to get into the other two ways that investors can control their investment, kind of more the nitty gritty. And the next one is the market, understanding the various markets. And so, Taylor, would you take a moment to recap that for us?
Yeah. So with the markets, there are plenty of markets out there, and you can also make money in every single market. But when we do look at a market, we want to make sure that we're looking at markets with strong market fundamentals. Is the population growth increasing? Is the job growth decreasing? Or is there diversification of employers that are within that market, so we're not just dependent on just one industry? Is the median household income growing? What does the crime and poverty look like? Is it declining or is it increasing? Are these landlord-friendly states? Are there favorable tax laws for the operators, or will it be more of a hoop, just trying to go through, let's say, the eviction process, or trying to go through the permitting process? Just all of that in a nutshell, determining what do we truly like in a market. Maybe we're looking for states that have no income tax. Maybe we just want a little bit. And they're more likely than not, you're probably not looking for a state that has pretty high income tax.
Maybe.
I mean, yeah, I guess.
Well, but I think what you said there is that, you can make money in any market. I think, for, how I try to help and you try to help investors orient to this is, you're investing passively. So, and you're not overseeing the day-to-day operations of the asset yourself. Maybe you're a single family landlord and you're moving away from that, or have small multifamilies and you're moving away from that and getting into it passively, or even just complementing your portfolio. It's just that how then can you put all these investing cards in your favor so you can kind of shore up that foundation, and then, lend more, since you aren't into the asset on a day-to-day operational basis, like just make sure that it's going to, shoring up the foundation. The financial moat is what I usually kind of call like part of the business plan, right? Like stacking all those cards in your favor, right? Because if you've got people moving in and they can pay that in their job, there's plenty of jobs, and their incomes are fairly high, you have people to rent to, tenant to, purchase whatever it is that you're looking to sell, or that operator is looking to sell. So it just makes business a little bit easier and smoother.
Mm-hmm. Yeah, I really liked what you said about stacking the criteria as well, because they all generally flow in with each other as you start to make this decision to invest. And, even when it comes down to not just on the state level and on the metropolitan area level, but you can even get down to the submarket level too. And granted, if you're looking to invest in a very particular submarket, the deal flow might not always be there just because you're only focused on this one part, but at least you would know that you would know who's investing in those areas.
Yeah, I mean, you bring up a good point there, because we had Eric Fitzgerald on a few weeks ago, our director of acquisitions, and he drew out kind of a map of Charlotte, and he said, we're in Charlotte, North Carolina. You caught that, thank you. anyways, but it's not just Charlotte, right? You can't just look at this huge metropolitan service area, throw a dart and go, great, like all these cards are stacked in my favor. You actually have to start drilling down into those different submarkets and putting yourself in the path of progress to make this an even shore up your business plan even more. And so the cool thing is, as a passive investor, you're not doing this yourself. You're going into business with an operator that is doing this for you. So that's amazing. Mm-hmm. All right, now the last part, my favorite, is the deal. And this is where a lot of investors start when we talk to them. They're like, tell me about your returns. And that's really where we don't want them starting. We want them starting at their goals, and to make sure that there's alignment, that we're aligned as partners, by all those questions at the operations level. Do they understand where we're investing? And now we can get down into the deal.
Yeah. And, I do want to bring this up as well as we go into the deal. And you bring up a good point where I think this is also where investors do make that mistake, is starting with the deal first. At the end of the day, when we do and make that investment, I think we realize that we are a lot more emotional human beings versus just being very transactional and caring about the numbers. I mean, at the end of the day, if somebody just comes in and says, hey, look at these returns, 2x multiple, 7 to 9% cash on cash. Yeah, sure. Those returns sound great, but where is this asset? Who am I investing in? And so understanding the type of deal and the operators that go into it now in the market they're in, and then stacking up as we move towards this deal focus, I think is a great, progression towards that decision. And so the type of deal, you can go based on the different asset classes. Are you looking to invest in multifamily, self-storage, express car washes, hotel? Maybe you want a more liquid option like the debt fund, or maybe you want a development deal. Are they planning to hold the asset for about 5 years, 5 to 7 years? Or are they looking to refinance in years 2 or 3? There's so many different ways that this deal can come about that you get to choose which deal you like and fits more with your goals.
Mm-hmm. And I love the fact that you touched on that we aren't as objective as we would like to think we are. I'm actually in a book reading. I'm reading the book, Morgan Housel's book, The Psychology of Money. And believe it or not, I'm like 2/3 of the way through the book, and there's like 0 in there about how to assess an asset. It's about how to assess you and how you are reacting to the environment. And it's really interesting. If you guys haven't ever read it, I highly suggest you read it. But it's we aren't as objective as we like to think we are. And when we're going into business with people, we have to make sure that we're kind of putting these steps in the right order to understand what we want, who can help us deliver that, and then we can get into the tangibles of kind of the more objective pieces, like analyzing the market and the deal. And then so you did a great job of recapping the type of the deal, the business plan. Then we can also get down into the minutia of it. I did a webinar back in December. I'll probably repeat that here, in September as well. But just how can we do a quick screen of a deal, looking at cap rates, looking at the capital stack, what is the equity multiple, the IRR, the various returns of the deal, and kind of helping you understanding on a continuum what is an ideal deal, and then also what warrants further question within a deal. And here's the thing: you might have your perfect columns lined up, you're going down every single piece, all these criteria points that you might have lined out for your deal. They're not all going to line up in that ideal category. Very few. So we have to understand where, what's acceptable, or I shouldn't say acceptable, what is non-negotiable for you to invest in, going back to your goals, and then what is, something that you can, you're willing to take on, and mitigate the risk as much as possible.
Yeah. And, I was just thinking as you were, talking about the returns, the metric, and just the capital stack itself, as we go into the minutia of the deals, is when people come in with their goals and their investment criteria, sometimes I hear that, I'm looking for a 7% cash on cash return. Can you give me that? And it sort of comes off as you're just trying to get through this checklist of criteria saying, okay, hey, if I can hit all of these, great. And I think that especially when it comes to these partnerships, if you come in treating it like that, the operator can also end up treating it like a transaction as well, instead of actually building that long-term relationship, which most operators in this game are trying to build today, especially because, I mean, the majority of these holdings, I would say on average, 5 to 7 years, that's a long-term relationship. And it shouldn't be transactional. And so, you know, taking into the account of the criteria of what you're looking for, but then also making sure that there's that flexibility behind it and investing in that relationship, in that partnership.
Yeah, and you've said something before that I just want to, highlight here is a great operator can take a mediocre deal and like smash it out of the park. Mm-hmm. And an operator who's not really worth their salt probably will take it or could take it.
Yeah, a bad operator can be in a really strong market and tank that deal regardless. So you really want to make sure that like, and trust. But as we go into the end of this conversation, I would actually want to know a little bit more about your passive investing experience, Whitney, and I guess just dive into some of those experiences where you are talking to other operators and like what worked well versus what didn't work well, and sort of like was a red flag for you. Have you ever been in a scenario where, I guess you were talking to an operator, reach out to them, and I guess you go through the criteria of, yeah, it works out, and then you decided not to invest in that operator? Has there, and what were those reasons as to why?
Ooh, okay. A lot to unpack here. Okay. So, and I feel like a little bit in the hot seat here.
Yeah, I didn't mean to throw you into the hot seat. I know that my face was right there in the webinar, but you have so much knowledge that I think that a lot of the other investors can take into account too. I mean,
yeah. So to start off, like when I started investing passively, I really wish this education was out there, because it was there. It was buried in books, but this industry hadn't bloomed like it has now. There wasn't a lot of this out there for free. So first of all, I just want to acknowledge there's so much information out there. You're blessed as an investor to be able to like put together, understand what needs to happen in deal and move forward very quickly if this is an area you want to invest in. For me, I felt like a lot of this was, I was kind of hunting and pecking, trying to find people that had passively invested before. The industry was very new. It was very difficult. And I made a lot of mistakes. I really did. I had the wherewithal. I had a business background. So, I treated it like an interview, right? Like I'm hiring my COO, right? That's how I was treating it, right? I'm the strategist. Okay, I needed to understand my goals at a high level, but I'm looking for somebody to execute on my behalf. So, as my investing developed, I started adding a lot of questions to these lists. I can echo a lot of things that Dan says in his 7 red flags. One, I've moved away from investing with operators that are only doing this part-time, or where there's only one operator in the deal. And reason being is because either they're not fully focused on my money because they're doing this part-time, or they are, there's only one person. What happens if something unfortunate happens to him? And it doesn't have to be like getting hit by a bus. I mean, it can mean like there's death, divorce, dislocation, meaning they're moving across the country, something disruptive has happened to their life. What happens to me as the investor? So there are all those things. I've had my world rocked by, a family, my husband broke his neck, and then 3 weeks later, my mom passed away, and I was operating my own assets at the time. I understand how disruptive those type of things can be, and they happen more often than people let on, probably. So when I started adding all these questions to my list, and these are the things that I share in the various master classes, they're there for a reason. I know somebody might look at this and go, wow, that's a really long list of questions, and why on earth is she asking about that one? It's because, it's something that's now become a non-negotiable, or I just want to know where I stand and understand where that operator stands so I can make an educated decision if I want to be in business with them or not. Okay. For me, those are really the things. I mean, have I had investments go sideways or south? Yes, I have.
Ooh.
Yeah, it
Oh,
happens, and it
are we gonna
happens.
share this? I mean, we're not gonna call them out, but
No,
I do think that I mean, those can definitely be learning lessons too, and
yeah,
for these investors that are just stepping into it.
yeah. I would say like two things stand out for me. One, I was investing with an operator who was not, I should say, I was investing with a sponsor that was not an operator. Now, guys, that doesn't preclude anybody, right? That's fine. But I was investing with somebody who didn't have day-to-day operational control. And I did not know that. So when the asset started
Mm.
going sideways, I'm asking all these questions like, well, what are you doing? And they were like, well, the operator's doing this. I'm like, well, aren't you the operator? They didn't have any day-to-day control or say on, how that asset was going to play out, what was changing with the business plan. So I've kind of backed off from investing, doing that type of investing, because I want whoever I invest with to have some sort of control. Now, there are a lot of great people out there. That's just my criteria. But in this particular investment, it was a self-storage investment. It went a little sideways. It actually did not cash flow the entire time. We took no, it's supposed to have monthly distribution at 9% preferred return, zero for 3 years, 0%.
Oh
Yeah.
no.
I had it in my IRA. To me, it didn't really matter. I wasn't as up in arms, but when it
Yeah.
sold, we got a 2.25 equity multiple. Okay.
Oh wow.
Yeah. The market helped us out on the exit. Okay. So I call it a win for my portfolio. And I maybe it's a win for the underlying operator in the deal because they were smart and decided to exit in a stronger market. But there are certain things there that I realized that I hadn't mitigated as well as I could. And that was, for me, investing with somebody that's the actual operator on the deal.
Mm. And so not, and no, that actually brings a good point too, because I do know that there are some co-GPs that have, great relationships with other operators, and some are a lot more than hands-on co-GPs than I would say other co-GPs. I mean, some of them, they just bring the equities to the deal, and then or are there any specific questions now that you would ask, let's say, somebody that isn't the operator that's bringing in the deal as a co-GP?
Yeah, I guess just to kind of suss out that relationship is just like, are you the operator of the deal? Yes or
Hmm.
no? What is your role? What are your day-to-day responsibilities on this asset? If something were to happen with the business plan, how much of a say do you get? Because any one of those questions could be answered, in any, in different ways to allude that they actually have some sort of day-to-day influence. But I think it's kind of like peeling back the layers of the onion to really like understand where they sit in the deal. Now, I always explain this, like when you're looking at a general partnership, it's slices of a pie, right?
Mhm.
Especially when you get into co-GP relationships, there's going to be a loan function, operation function. There's going to be financial function. There's going to be investor relations function. And that often gets shared is what, the investor relations function. And I don't mean just the capital raise. It's beyond the capital raise. It's like who is taking care of that investor. But you always want to understand, what is the operational role? What is their asset management role? And then do they have any influence over day-to-day operations? Those are the 3 key points to kind of hit home on.
I love it. Now switching gears, I know we've been talking a lot about like what to watch out for. And in a way, it can almost seem very daunting and intimidating, saying like, oh, there's red flags here, red flags here, red flags here. But now in your
I can scare the
experience,
pants off of anybody.
yeah, I mean, at the end of the day, it is kind of scary going into this if you don't necessarily know anybody that's in there, or you don't have anybody in your network that's going in there. And I mean, even my parents have thought that this was a Ponzi scheme before I actually joined passiveinvesting.com. And so, I mean, now I'm just going on a rant and a tangent, but now moving forward into the other side of the equation, we've talked about looking for red flags. What does a good operator look like? And what has been some unique moments in your experience as you were talking to other operators to that you're like, you know what, I trust this person, and the fact that they're, I guess, going to be doing what they say they're going to be doing.
Yeah. I think going back to those questions that I shared, right? Even before you get on that conversation with the operator or the operations team, you're going to see that operator, more than likely on social media, on YouTube's, on Facebook, maybe hear them on a podcast, hear them speak at an event. Hopefully you can go to a conference where you can kind of shake hands with them and bump elbows with them and look them in the eye, see the whites of their eyes. I really love that. Call me a little old school. I love like actually shaking hands and going, wow, you're a real person. So
and you look only at the whites too, at the whites in the eyes.
So
the whites in the eyes.
Else.
Yeah, white, they just stare down and you go to conferences and you see Whitney just stern stare.
Oh my gosh. Anyways, but so those are, where are you kind of running into them online? Their personalities are going to come through, and in those types of interactions. Their knowledge is going to come through in those types of interactions. Their helpfulness will come through. How genuine are they? And then moving on, getting on the phone with them. There are investors out there that invest in deals and never talk to the operator. That's just not me. I want to have that personal connection, and we really encourage it here at passiveinvesting.com. But getting on the phone with the operator, one, you're checking everything, all your assumptions, right? We already talked about, we alluded that us as human beings, we'd like to think we're very objective, but we're really truly not. And even when it comes to managing money, even if you have the best spreadsheet in the world, there's a lot of emotion that goes into there. So, have that conversation and just kind of double check everything that you have researched on the operator. And then, kind of evaluating over time, with that operator, are they doing what they're saying that they're going to do? And how I kind of keep track of that is, when I get the pro forma and I decide to go in an investment, I'm actually keeping a spreadsheet of the operator, the amount invested, the date that I invested in, what their projected IRR was, an equity multiple. And then I'm tracking what my monthly distributions, like over 12 months. Okay, I like spreadsheets, guys. I come from a public health epidemiology background. These spreadsheets are my life. But anyways, keeping track all of that information, because when you get to the end, you want to actually, that operator is almost re-interviewing again on whether you're going to continue investing with them. Are you going to continue to go forward in a 1031 exchange into the next asset? Or are you going to be like, wow, they didn't deliver what they said they were going to. They missed deadlines. They didn't communicate very well. Now you have tangible data, right? All those things you can keep track of. You have objectiveness to that emotional component, and you can make a good decision. So what gets measured gets done. I forget who said that. I know I've heard it through Tony Robbins, but that too can actually help you understand, like, kind of getting into a relationship with an operator. Then also, am I going to continue this relationship going forward with them?
I'm going to coin that. You're the one that said that now. I don't even know who Tony Robbins is. I'm going to quote that. Whitney, what gets measured gets done. I love it. Whitney Elkins-Hutten.
No, I can't. It's probably Jim Rohn. Knowing Tony Robbins, probably Jim Rohn.
Jim Rohn.
I'm sure that's trademarked somewhere. I can't take credit for that.
Right. Actually, more on I guess, granular detail, something that we didn't talk about too much was when we talk about the deal, the actual exit strategies. Then you brought up, if they're going to be 1031ing into our next deal, are they going to refinance and hold and you guys just cash flow? Or is there going to be a sale? Is there going to be a refinance in year 2 and then plan on selling in year 5? So really, what does that look like as well? I just wanted to throw that in there before we continue the conversation, because I didn't want to forget. I think
Yeah, no,
it's
that's a
important.
great, when you're evaluating the deal.
Mhm.
Actually, that I would ask those questions at the operations stage, like when you're talking with the operator, like what is their typical exit strategy? And it's going to vary strategy to strategy, like
Mhm.
hotels, self-storage, car washes.
Yeah.
What's their exit strategy? And then, see if that holds true at the deal when you have it there. Now,
Right.
I'm kind of keeping my eye on the time, Taylor. I want to make sure we have enough time for our after party. Um, any parting words? Like, if there's one thing that you want people to get away from this episode, from us having this conversation, what would it be?
What's measured gets done. No,
The
no,
last 30 seconds.
yeah. No, I think, I mean, I don't have, I guess, like a particular quote or anything like that. I mean, but if I were just to say, when going down this path, try and talk to as many operators as you can. Because the more you start to get familiar with who's in the game and the type of business plans, and you get to see their offerings, you get to compare and really just get an idea of and build out your own criteria. And also, you can probably build out your own goals as well. I mean, we can go in there thinking that this may be our goal, but then come out of it thinking that, okay, maybe I actually want to invest in something like this instead. And so, go out there, network, and partner up, and do your due diligence.
Awesome. I love it. All right, Taylor, thank you so much for joining me today. This has been amazing. If somebody wants to find you, where can they find you?
Yeah, so you can find me on passiveinvesting.com at the website. My LinkedIn profile is there, or you can send me an email at taylor@passiveinvesting.com, or you can even shoot me a text or give me a call. I'm pretty active on my phone as well. So, you know what? I was thinking about giving this out, or if I was going to give it out, but I know you can find it anyways, but might as well. 925-998-4205.
Awesome. Taylor
Mhm.
giving his digits out. Awesome. I love it. All right, guys. And thank you for joining us live today. Be sure to register at passiveinvestingwithwhitney.com for future masterclass sessions and to see our open deals. Until next time, thank you so much. If you're here live, don't forget about our after party.